Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 340 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including current geopolitical events and similar events in the past, the US dollar, mortgage rates, valuations, major indices contracting before a possible expansion, drawdowns, and tax withholdings. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So welcome everybody. Today we are doing something a little different here. We are recording virtually just from calendars and schedules, and joining me today is a wealth advisor here at Jessup Wealth Management, Aaron Kramer. So Aaron, thanks for hopping in and filling in for Matt today.
Happy to be here. It's always fun. Always enjoy jumping into this stuff. It's great.
It is, and there's no shortage of things to talk about today, so we'll just hop right into it. First, we will talk about the performance for the major indices that we track. These numbers are going to be as of the market close on March 4th, and this data is from YCharts. S&P 500 index down 0.1% so far for the month of March and up 0.4% on the year. Dow Jones Industrial Average down 0.5% for the month and up 1.4% for the year. The NASDAQ Composite Index up 0.6% for the month and down 1.9% for the year. The Russell 2000 Small Cap Index down 1.1% on the month and up 6.3% on the year. And the Vanguard All World X United States Index Fund down 4.1% on the month, but still up 6.6% on the year. 3-month Treasury rate at 3.71%, the 2-year at 3.54%, and the 10-year rate at 4.09%. So obviously some weakness to start this month in the markets, particularly in international stocks, which I guess isn't too surprising, Aaron, with everything going on kind of overseas in Iran right now. So, I think it's no secret that the U.S. and Israel struck Iran over the weekend. We, as we always do, are just going to focus on the market impacts of this. So this is not a, politically driven podcast or, the opinions of me and Aaron. We're just kind of give you our viewpoint from, where we sit and what we do from day to day for clients. So, Aaron, typically when things like this happen, number one, the first thing I want to say, it's not uncommon for these types of events to occur over the weekend, right? Sure. If it occurs during the week, people can react a little bit more harshly without thinking about it. So it's not surprising that this happened over the weekend. I think the hope there is that people will, have some time to think about it, and then from a market standpoint, decide what they want to do on Monday morning. Yep. And I was going into this week, Aaron, thinking that on Monday morning, markets across the world were going to be down 2 to 3%. Sure. Just because, we've seen some, things like that happen before. And then, one thing that we talk about here a lot on the podcast is the VIX, or the volatility index. And, I was expecting a spike into the 30s or even potentially low 40s. On Monday morning, the VIX was only at 27. And that just seemed low to me for everything that was kind of going on. And the other encouraging thing from a market standpoint that I saw was, on Monday and Tuesday morning, the market opened up very weak, but then it strengthened throughout the day.
Rallied back throughout the day, for sure.
Yeah. So on Monday, opened up red and then finished the day green. And then Tuesday opened up even more red and finished the day less red. And there was, this kind of consistent buying throughout the day. And, what that tells me is that you have, you know, a bunch of money that is panic selling at the open, and then slowly and steadily throughout the rest of the trading day, you're having these larger financial institutions step in and buy from those people that are panic selling. And that's, from a market standpoint, Aaron, exactly what we would kind of want to see during a time like this. If the roles were reversed and the market was opening up strong and fading throughout the day, I think we'd be having a different conversation. But, so far, at least this week, I think the market action has been just about as encouraging as it could be. And we came into to 2026 expecting some volatility, right? So we've talked, ad nauseum about how it's a midterm year. Midterm years are relatively weak. Usually a typical midterm year looks pretty weak for the first 10 months of the year before, the market kind of gets its crap together through Q4 and then into Q2 of the following year. Because what's interesting about this 4-year presidential cycle that we talk about so often, Aaron, is that, the weakest part of the 4-year cycle is followed by the strongest part of the 4-year cycle.
Right.
And like I just said, weakest part being roughly the first 9 to 10 months of the midterm year. And then from Q4 of the midterm year through Q2 of the pre-election year, which is next year, 2027, usually is the strongest part of the cycle. So again, I think a really good example of volatility that hit the market that happened less than a year ago was the tariff situation in April in 2025. And, at one point in time last year, things looked pretty bleak. And I
the
think
market was down, almost 20%, right? So
and I think, if someone would have asked me or would have asked you, hey, do you think the market's going to be up double digits at the end of 2025? I think we probably both would have said,
I would have
probably not.
guessed, mid to high single digits would have been my guess for last year.
Right.
And
So, and fast forward and look what happened. The S&P 500 was up double digits. So, and you had all of these experts on TV saying that tariffs were going to wreck the economy and drown the stock market and inflation was going to reignite, and none of that ended up happening, right?
Right.
So I think, that was a really good example. And I think this is a really good example of, the reason why we stick to our long-term game plan, right? We don't
Absolutely.
react to short-term market events or major news headlines, right? Because that could really set someone back. And I think it's also important to throw out too that, we plan for this type of stuff when we're putting a portfolio together or we're putting a financial plan together. Volatility and sell-offs are part of what we do. So it's not like that this is something that completely caught us off guard. Now, the event, we didn't know exactly what it was going to be that drove this volatility this year. So I just wanted to kind of just take a couple of moments and talk about that and how we're looking at it from, from an investing and from a market standpoint. Is there anything you want to add to that before we
No,
move
I
on?
think really just, the market, the stock market is extremely resilient and able to shake off these Middle East conflicts. They tend to happen a lot, unfortunately, but the market tends to, have some short-term volatility and reactions and shortly forgets about it. So it's, the reaction to the market again is a little bit surprising. I agree with you. I think it would have sold off a little bit more this week. But I think it goes to show that, that the market's not that concerned about it. I think one of the bigger concerns was obviously the Gulf and the shipping. And I think with the administration's kind of strategy to ensure those shipping routes was gave some cover for the market to not react as much, is my opinion. So
yeah, agreed. And yeah, I think it's just one of those things that we get a year or two down the road, we're going to look back on this, and again, from just a pure market action perspective, it's going to be, another blip on the radar. And I know
Absolutely.
that you have a piece
I've
or
got a
two
good
later.
piece on this. Yeah, absolutely.
So
before we get into this week's show, listeners, if you've been enjoying the Independent Advisors podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving into tweets, articles, research from this week. First thing I had, Aaron, was a recent magazine cover from Barron's and The Economist. So
yeah, they're on theme here, aren't they?
They are. So it was kind of like a double whammy. So for those that might be, newer listeners of the podcast, we'd like to talk about magazine covers that come out from these major financial media companies, right? Or magazine companies. And Barron's and The Economist are two of the biggest financial magazines out there. And, in the past, typically when something makes it on the cover of the magazine, the opposite tends to happen. And it's not all the time, but, we've given several examples here where, some topic has made it so mainstream that it ended up on the cover of a magazine. And, by that point, the market has already priced that in, right?
Right. Absolutely.
So this month's or last month's topic was the US dollar. So I don't think it's been any secret that for the past year and a half, Aaron, the US dollar has been very weak.
Yes.
And that has led to what? That has led to international stock outperformance. Typically,
Absolutely.
when you have a weak dollar, international stocks tend to perform well. When you have a strong dollar, domestic US equities tend to outperform international stocks. So the most recent magazine covers from Barron's and The Economist are talking about this weakness in the dollar. And Jenna will throw these magazine covers up on the YouTube video. They'll also be in our show notes. But the Barron's magazine cover has kind of like a dollar, falling off the side of a cube, and it says what the tariff decision means for markets. Dollar in decline. The U.S. currency has lost its dominance. What investors to do now? And then shortly just below that, you have The Economist that says the dangerous dollar, and it is a snake hissing with dollar signs on its back. So
creative.
very, very creative. The one that really got me was at the bottom of that Barron's magazine cover. It says the U.S. currency has lost its dominance, and
that's still very, very, very debatable.
very, very debatable. That's very early, I would say, to claim that. But then if you go and just pull up a chart of the U.S. dollar, I mean, you can't really time this any worse for them, Aaron. I mean, the dollar, at least for
like
right now,
immediately flipped.
yeah, it bottomed on, at the end of January, and these were out in February. And, since the end of January, the dollar has been up pretty substantially. It's been up about 3.5–4%, which is for a currency is a pretty big move, right? Now it could always turn around and the dollar can fall, but again, just think it's a really good example where they pretty much just time the low for the dollar. And I think this is also an interesting conversation because, international stocks have been very, very strong.
Yes.
2025, they significantly outperformed U.S. domestic equities, and it's kind of been the same story up until this past weekend in 2026. So I think the big question that I have, and the thing I'm going to be looking at, is if this dollar strength continues, do we start to see that rotation back into U.S. equities?
Agreed. Yeah, I think that's the big question. My general opinion is I do think the dollar is resilient and will continue to recover. So not a time, again, just my opinion that international should be a massive overweight.
Yeah.
But that's why you diversify. There's a place for it. You want to have some exposure to it. When you do have those outperformance years. But historically, the last decade, international has been a laggard versus the U.S. market. So,
Yeah, I think we still need to see some more before we call it a turnaround in trend that's going to last
sure.
for the next decade, right?
Agreed. Agreed.
Next was mortgage rates. So this was kind of a surprise to me. It's been quite a while since I've checked in on mortgage rates, but for the first time since 2022, mortgage rates dropped below 6%. And I'm talking about 30-year mortgages here,
Mm-hmm.
Aaron. And this data was as of March 1st. This is something that kind of has fallen under the radar, I would say, over the past few months with everything else going on. When interest rates skyrocketed, really it started to make a move off of the low in 2021 and
Mm-hmm.
early 2022. Um, you know, People were not happy, right? I mean,
No, not
the
at all.
higher mortgage rates and these rates getting, between 6 and 7 and sometimes closer to 8% for mortgages made it very unaffordable for a lot of people that were trying to get a house, and
Mm-hmm.
especially first time home buyers. They were kind of put, in a tough situation, but with obviously, inflation coming down over the past year or so, with the Fed lowering interest rates, mortgage rates are starting to follow that. So all that being said, I do think that maybe over the next year or two, there might be some more attractive opportunities or affordable opportunities for people to go out there and buy a house and get a cheaper mortgage, as long as the Fed continues to cut. So
Absolutely.
just
Yep.
wanted to throw that out there, something that I thought was interesting because I haven't personally been paying a whole lot of attention to it, but this was a big topic of discussion, a year or 2 years ago.
Absolutely. No, it's that over a 1% move off the highs is will help people a lot with affordability. We'll just
100%.
have to see what the reflect in that in housing prices are, right? Because that's kind of been the double whammy is that, we had housing prices rise 20, 30%, 40%, since COVID, really due to those ultra low rates. And then rates go up and the prices didn't really fall. That's a mass generalization. Obviously, prices have moved in certain segments and areas, but across the U.S., real estate prices have been fairly sticky. So
Yeah,
yeah, I
they
think
have been.
it's a great thing for the affordability. And I know in past podcasts we've looked at what's the average age of a home buyer now, and it's pushing 40, 50, 60 years old. I'd like to see that number come down more towards like 30, 35, 40 years of age. So
Yeah,
yeah, it's a trend in the right direction.
it is. It is. The last thing I have was a blog post from Matt Cerminero on February 24th titled "The Craziest Stat of 2026." We've had Matt on the podcast before, so you can check him out. So it was a really good blog post, but I wanted to focus on a specific section that piqued my interest. And this chart, again, will be up on the YouTube page. Jenna will put it in our show notes. So Matt says this. He says, "We all know the Mag 7 has been lagging and consumer staples have been ripping this year. I'm not, breaking any news. But did you know that as of February 24th of 2026, the average forward PE ratio, price to earnings ratio, of the Mag 7, excluding Tesla, is now below the consumer staples sector? For 99.6% of days over the past decade, the Mag 7, excluding Tesla, has traded at a premium to the consumer staples sector. It is now trading at a discount." Um, this was
That's
something
incredible.
that,
That's incredible to me.
yeah, this was something that I had to read a couple of times to believe it, Aaron, and did some checking on my own through Y charts, that piece of research software that we use, and he's right. which goes to show you, how hard some of these, tech names have been hit over the past 6 months, if you want to call it that, since the fall. And again, I don't want to steal your thunder. I know you have a little piece on this
that's totally fine.
in a little bit, but for all this talk about the market being overvalued and tech being overvalued and AI being overvalued, you have some of the most important companies in the world that are trading combined at a valuation that's lower than an extremely defensive, historically cheap sector. And again, just the price to earnings ratio is a very popular fundamental metric that investors and money managers use to determine if something is overvalued or undervalued. So it takes, the price per share and divides it by the earnings per share. And that gives you, the PE ratio. And typically when the PE ratio is higher, people tend to think that companies are more overvalued. When it's lower, more undervalued. Doesn't always work out like that. But I just thought it was interesting because that was not something that I expected to see at
Extremely
this
surprising.
point in time.
Yeah, well, and I think it goes to show you that just how fast those large tech companies and AI companies are growing. Their earnings are growing at 20+% per year, and a good consumer staple stock might be growing 4 or 5, right? So with that forward PE metric, I guess it makes a little bit more sense, but it's still extremely surprising. But yeah, I think, personal opinion, it would not surprise me if Wall Street, is going to start scooping up these names. And we could see some of that rotation to the flip side where, consumer staples that have done really well. My guess is over the next few months that trend flips. But we'll see. Great,
cool. Well,
great blog post. Yeah.
Yeah. Thank you. I will turn it over to you.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Awesome. First item I got here is an X post by Bespoke. I always love their charts and use their stuff. This was on March 2nd, and it's the tightening of their moving average bands on the S&P 500. So you'll see that, basically since middle of 25, there was a pretty good, divergence between the moving average bands of the 50-day moving average. And as we've gotten into 2026, those bands have really, really narrowed. So that kind of consolidation, if you will, in volatility tends to mean one of two things. It tends to mean the market's getting ready to make its mind to move in one direction or another. My opinion is I think, getting through the next several weeks and months here and getting past a little bit of volatility, my guess is it moves towards the upside as, companies continue to release earnings. And, high quality companies, the Mag 7 that make up a lot of the S&P 500, I think will cause this to move in the positive direction. What are your thoughts?
Yeah, it's a great point. It's one of my favorite sayings in our industry is from contraction comes expansion, right? So
absolutely.
When we talk about the market contracting, as you said, Aaron, it's kind of just like trading in this small little range. There's a couple days that are up, there's a couple days that are down, but the market's not really going anywhere.
Moving sideways, right?
It's moving sideways. And the way people can think about this is, pushing like a beach ball underneath water, like if you're in a pool, right? So you push it down and you let it go. and the ball pops up out of the water and into the air. Well, you can think of, volatility and contraction the same way. Whenever you get these prices trading in this tight of a range, usually, like you said, tends to break one way or another eventually. So it's not a matter of if, I think it's a matter of when and what direction it goes. But the longer trend, like you said, is higher. So, the path of least resistance is higher at this point. So we'll have to wait and see, and maybe it's a catalyst from a deal being done over in the Middle East, or some more news on the tariffs and the reimbursement of tariff revenue collected so far up until this point. We don't know what the catalyst is going to be, but there will be one. It's just a matter of what that will be.
Absolutely. Excellent. Next thing I got is another X post by Ben Carlson. Again, I always love his stuff. He's one of my favorite blog writers and authors in the financial services industry. This was on March 2nd. And his post says, some rules for dealing with uncertainty. Strong opinions, loosely held. Be skeptical, not cynical. Discipline matters more than optimization. If all else fails, simplify. Doing nothing is a decision. So, I mean, he puts this out due to the conflicts in the Middle East with Iran, and he overlays a chart here, which again we'll put up in the show notes, that shows the S&P 500 going back all the way to 1928, and it shows it's these different periods of time when we've had wars and conflicts. And I think the reason he does this is to show that these conflicts tend to be short-lived. And I like the words he says there. Obviously doing nothing is a decision. Sometimes that's the right decision, in my opinion. And I think that tends to be the case with these wars and conflicts is, stick with your long-term, plan. It's not a time to make rash decisions or fear sell. In my opinion, it's a time to, continue as is with your long-term, growth trend and portfolios. What are your thoughts?
Yeah, well said. I really don't have much to add. The only thing I guess I'll say is, I've had a bunch of client meetings this week, and obviously this is a popular topic of conversation. And at the end of the day, I think the most simple way to explain it is, there's been, how many different instances of war,
I mean, there's
or
probably
attacks
a
are on this chart,
couple
Aaron?
dozen on here. Yeah.
Yeah, right. So, since 1928, there has never been a time where the US stock market has not recovered. And if I was a betting man, I would bet on that trend continuing. Now, obviously, I chose my words carefully there because I said US markets. We've had a different situation with Japanese markets for, being in a drawdown for 30 plus years, but US markets, at least, they've always recovered. So I think if you are pushing your chips to one side of the table or the other, I think you have to keep betting on that trend holding true. And like I said, the market action has been very encouraging so far this week, in that it's telling me, it's not going to last much longer.
Sure. Awesome. All right, I got a couple more things for us here. One more X post, and this goes, kind of hand in hand with Matt Sermonaro's blog post. This is an X post by Charlie Bilello on 3/3, and it's an update on technology stocks, crypto, and a couple other like gold, a couple other areas of the market. And it shows the percent off of their high. So I'll just throw out a couple numbers here. Apple is 9% off its high. Amazon's 19% off its high. Again, these are a couple days stale at this point, but Palantir is down 29%. MicroStrat down 76%, which is really tied to Bitcoin. So, these are some big moves off their highs, and I think a lot of this isn't necessarily justified based on the financials and knowing these companies, especially the top half of this page or this post. Gold's kind of the outlier. It's Commodities are a whole different ball game, so I'm going to kind of say everything ex gold. But I do think my opinion is there's a lot of value here, and I think it goes hand in hand with that blog post that, the forward PE of a lot of these companies is now on par with a consumer staple stock, which is just crazy when these companies are all growing 20+%, if not more on some of them. So, any thoughts, comments?
Yeah, I just think it's pretty impressive that, the S&P has managed to hold up as well as it has.
It's
Now
had a lot of
it's
breadth now in
yeah,
market
it's still
rotation.
down, still down, and we've still had some weakness, but you have some of the largest names in the index that are down, 20+% off of their highs. And, if people are waiting for a larger correction in the market, it might happen, but it might not. There's kind of like this stealth correction that's been going on underneath the market with some of the most important names out there that are publicly traded. You have a name like Microsoft that, at one point was 30% off of its highs. That's a pretty steep correction for a name like Microsoft. Same thing with Amazon, 20% off of the highs. So, it wouldn't surprise me that if, the market continued to weaken, if a lot of these individual names start to go against the grain and turn higher because they've already had this pretty big correction. So, yeah, market action has been interesting, to say the least, so far in 2026. Yeah, my favorite ones were Trump coin and Melania coin down 96% and 99%
Yeah.
respectively. So yeah, that's crazy
Yeah,
stuff, man.
I was looking at this chart more for the Mag 7 kind of
I
names and
figured
the
you were.
Palantirs.
I
But
figured you
those are
were.
funny that he threw those in there.
Yeah, yeah. So,
Um, all right. Anything else before I move on to the financial planning topic of the week?
no.
Excellent. All right. So I thought this was a little timely. I like this IRS. As fun as the IRS is, they have a good IRS tax withholding estimator. So it's actually there's a link to it right on we can have that in the show notes, and it's basically helps you fill out your W-4 if you are a W-2 employee. So this is a standard process for me. I do twice a year. Tend to do it at the beginning of the year. Tend to do it middle of the way through the year, just to make sure, hey, am I withholding enough taxes? Am I not withholding enough taxes from my paycheck? So it's basically you take a couple pay stubs, you look at your 2025 tax return if you have that done. If not, you can use your final pay stubs. If you're a married couple, make sure you have two accurate pay stubs for each of you. It's a 20-minute process. It's not bad. So, you just kind of answer the questions, your filing status, and it basically spits out if nothing major changes, so you don't get any major bonuses or different pay increases. It's going to show you, are you under withholding or over withholding based on your filing status. So, it can help you avoid penalties. And it can help you say, hey, you need to withhold an extra $50 a paycheck so that you break even or you get a little bit money back on a return come the next year. So I will say if you are a complex individual, say you have, outside income, you could factor that in. But normally I would reserve that to talk to a CPA. If you're just normal, single person, married couple, W-2 income, nothing fancy or extremely high earning, this is a great site. So for 99% of people, it's going to get the job done. If you're those upper 10+% earners, it might not work perfectly for you. But yeah, I thought this was timely with tax season, right? March or April 15th is coming up pretty shortly. And it's a good process to kind of go through at the beginning of the year. Make sure you're not drastically under withholding or over withholding, because you don't want the government using your money all year long, and you
Yeah.
don't want to have to owe a surprise tax bill either.
Yeah, it's I think it's one of those things that people don't realize that yes,
It's out there. Yeah.
and there are penalties associated with
Hmm.
not withholding enough. So I know at least when I first came into the workforce, and again, this was obviously years ago, I was way younger, a lot more naive, but I didn't know that. And the first time I got my taxes done, the accountant was like, "Hey, you're not withholding enough." And I was like,
Sure.
what are you what are you
What
talking
do you
about?
mean?
I'm going to pay my taxes at the end of the year. So it's definitely very nice that they have a tool for this, like you said. So I would highly encourage people to just go make sure they are withholding enough so that they are not hit with any surprise penalties
Absolutely.
at some point. So Aaron, thank you very much for joining us today. I always appreciate your insight and thoughts on things. Hopefully it won't be too long before you're back on and we're doing this again.
Absolutely. Always fun. Enjoy it. And I will be happy to be back anytime.
All right. Well, thanks everyone for listening to episode 340 of the Independent Advisors Podcast. Catch us next week for episode 341.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.